Well, hello, everybody. Welcome back to another episode of the Wealth Building for Dummies podcast. My name is Kyle Demian. I'm joined here with Renji Matthew, and today we're going to talk about annuities, more specifically fixed index annuities, what they are, how they work, and how to know if you should look into one and if it's going to be a good recommendation for you. Renji and I have been licensed over the last, I think, what, 2 or 3 years for you, Renji?
Almost 3, yep.
Almost 3. And I've been licensed for almost 6 years now in the financial space. And we've helped a lot of clients set up fixed index annuities to help them achieve their retirement goals. And that's what we're going to be talking about today is how they work and when you should start to look at and at least contemplate whether a fixed index annuity is going to be right for you. So Renji, if you want to start us off, let's start by talking about the different types of annuities that are available and that are out there. And then after that, we'll go into the fixed index annuities and why we like them and why we typically will recommend them. So what different types of annuities are out there for people to put their money into?
Yeah, so there's different types, but the main three are there's fixed annuities, fixed indexed annuities, and variable annuities. And then each of those have their own immediate annuity, lifetime annuity. Those are all those flexible annuities. There's different things, but the main three are fixed, variable, and fixed index. And the difference between, and Kyle, you can expand on this some more too, but on the fixed annuities, the way that is, it's a fixed rate of return every year. You're getting a percentage growth every year. So you have nothing to do with the stock market or nothing. You're just getting a percentage every year. With the variable annuity, you're subject to the market because you can't lose money. And some variable annuities, they have a lower threshold, a lower floor in the sense like it might be -4 or something like that. So if the market goes below up to that -4, you lose money, but after that, you don't lose anymore. And a lot of them, though, they're not like that. You still lose money. So like we don't always see the reason to go with the variable. Then there's fixed index annuities, which is what we like the most because you have the protection just like a fixed annuity does, but you're indexing with the market. And when I say indexing, what that means, all that means is you're mirroring what the market does. So you're not actually in the market, but you're mirroring what the market does. So when the market goes up, you go up with it. But when the market comes down, you plateau. So you're never losing money. Now, when the market comes back up, you're growing from where you plateaued. And then I get this question asked to me a lot, Renji, but how are they able to do that? Well, think about it this way. What does a bank do? When you put 100,000, let's say you have 100,000 in the bank, what the bank does is they lend it back out to you in the form of credit cards, mortgages, loans, whatever it is, but they also take that money and put it into the market. When the market goes up or down, whatever happens, if the bank makes money or loses money, it doesn't affect you any. It's the same way these index or annuity companies do it. They take your money, but the difference here is if they make money, I like to say it as they partner with you. So if they make money, they split it with you. But if they lose money, it doesn't affect you any. So that's kind of how it works. You want anything to add to that, Kyle?
No, I think you did a good job separating the three with what the differences are. The variable, just like it sounds, it's going to go up and down. You can lose money in variable annuities, and they tend to come with higher fees. Fixed annuities just lock in a guaranteed rate of return. And then the fixed index give you the option to have some market-like returns, but without the market risk because they have a floor where you're not losing anything. And one thing I did want to do too is also just define what the word annuity means, because I'm sure people have heard of it before, or maybe they haven't, but they've never really had or seen a definition of it. So an annuity, by definition, is an insurance contract that's issued and distributed by financial institutions with the intention of paying out your invested funds in a fixed income stream in the future. So it's a financial account you could put your money in with the intent of sometime in the future turning on income, like for retirement income, right? So this is a retirement account most people look to set up with, and depending on your goals or whatever point of life you're in, there's going to be different things that maybe you're searching for and looking for to determine which of these annuities, if any, are going to make the most sense for you, right? Maybe if you're just looking for a guaranteed rate of return on some of your money, one option people look at traditionally to put their money into is like a CD or a certificate of deposit. People can look at that just to get a guaranteed rate of return of maybe 3, 4, 5% on their money. And CDs can range from anywhere from 6 month CDs to I think 2, 3, maybe even 4 year CDs. But these fixed annuities give you another option where you can have a set rate of return for maybe 2, 3, 5, 7 years. Variable annuities will go up and down with the market. My viewpoint on variable annuities are if you're going to put your money in a variable annuity, you might as well just put your money into the market. Variable annuities can have higher fees than otherwise you would just have if you put your money into an index fund or a mutual fund or had a financial advisor manage your money. But the fixed index annuities, and this is what we're going to talk about for the rest of our show, the reason why I believe, and Renji, you could tell me if you agree too, the reason I believe that they make so much sense for the majority of people is because you can get market returns without the market risk. So, what part of your portfolio, if any, would you want to secure and make sure that you never lose another dime from, but that you continue to grow based on however the market performs? For somebody in their 20s and 30s, it may or may not make sense for you. Yes, you have time where you can invest your money in the stock market, let the market ride its course, right? Because you're not retiring for another 30 or 40 years if you're going the traditional retirement route. For people in their 40s, 50s, 60s, and of course 70s, as you get closer and closer to retirement, something like a fixed index annuity starts to make a lot of sense, at least for a portion of your portfolio. Reason being is as you get closer and closer to retirement, there should at least be some of your portfolio that's completely removed from market risk. In 2008, when the market crashed 40%, if all of your money, all of your retirement savings was inside of the market, your $1 million would have been worth just $600,000 after the course of a year. And that's not your fault. You didn't do anything. It was just the market ran its course and you lost 40% of your net worth, right? So as you're getting closer to retirement, you need to protect a portion of your portfolio from assets to make sure that you can have the retirement that you desire. And that's kind of how I look at it. And Renji, not sure if you have anything that you want to add to that. Do you have anything that you want to add to that in regards to the fixed index annuities?
No, I think you explained it really well. It's the older you get, you wanna you it's this is money you've been protecting and growing for all your life. If you all of a sudden lost 20, 30, 40% of that, that's going to be heartbreaking, right? I'll give you guys an example. 2022, beginning of 2022, we had a 20% downturn in the market. I talked to so many people that lost a lot of money, but the biggest one was a client of mine. He was in his late 30s at the time. He makes good income. He had over a million. I don't remember. It was well over a million in his retirement accounts, and he had lost 400,000 in the market. But like Kyle said, when you're younger, that's okay. You have time for the market's gonna come back. You have time before retirement for it to come back up. But imagine if you were 65 about to retire and that happened to you. That is crazy and scary, right? Especially if that's the only amount of money you were going to live off of. That could be really scary. So the closer you get to retirement, like Kyle said, you want to protect more and more of that assets that you have that you're going to live off of. So you don't have to put all of it in an annuity, and with an annuity, what an annuity is, it's an IRA with a floor. That's what it is. Because difference between a traditional 401k and IRA and an annuity is the floor is the biggest thing. And there are annuities that most of the annuities have a contractual period where you can't touch money. But there are companies out there that will let you access 10, 20% of it. And Depending on what age you are, you can have access to more of that money without penalty. Of course, it is a traditional IRA, so you touch anything before 59 and a half, you have the standard government penalty. You can't get away from the government's penalties and rules, right? So that you can't get away from. But there are companies that allow you to have non-capped growth. Then we'll also, Kyle, are you planning to go into the different types of fixed index annuities too, like the income one, the growth specific ones? If not, I can talk about it now.
Let's talk about it now because yeah, I
Okay.
say let's start getting into the juice of what different types of fixed index annuities there are and like what kind of retirement goals they can help you or retirement
Yeah.
objectives they can help you achieve, which would be like income or just accumulation. Yeah, let's go into that.
Okay. Yeah, so if you are someone that's really close to retirement and your Social Security income's going to be really low, or you don't even know if you can live off of the income you're going to get, a fixed index annuity that is more concentrated on income makes a lot of sense for you. And the way these work, uh, let's just use an example of 100,000. Let's say you have 100,000 in a traditional 401k or an IRA, or even in the stock market. If the market, this is highly unlikely, but if the market does horrible for the next 10 years in a row, you would lose a lot of that money, if not all of it, right? Now, let's say you have a IRA with the floor, like an annuity. You would have all 100,000 in there if the market did horrible for the next 10 years. Now, in that same scenario, though, if you started taking out 10,000 every year out of that 100,000, you would lose all of your money in 10 years, right? And again, this is if the market didn't do any growth. But the benefit of a guaranteed lifetime income annuity is in that same scenario of having 100,000 where the market doesn't do anything for the next 10 years. Let's say they paid you 5,000 years a year or 5,000 bucks a year. I don't know what I'm saying, which comes out to right under 500 bucks a month, right? They would pay you that every month. You could take it out as monthly, annually, however you want, but they would pay you that every year for the rest of your life. They're banking on you not living that long, but even if you lived 1,000 years, somehow you figured out how to live 1,000 years, you would still get paid that 5,000 bucks every year. And even if your 100,000 runs out, they will still pay you that. That's why a guaranteed lifetime income annuity is really beneficial for someone that wants that secure, guaranteed income. That's one specific one. The other one is more growth specific. With these, they don't have a guaranteed income. You can turn on that option later if you want, but they don't traditionally don't have that on there. It's just more specific for growth. And a lot of times with companies, when you set up annuities, they cap your growth. Essentially, that's how it is. Let's say they cap you at 10%. If the market grows 20, you only get that 10%. But there are companies out there that have uncapped growth potential. But when it comes to the income one, most all companies cap your growth because they're guaranteeing you some type of income, so they cap your growth. And when it comes to the guaranteed lifetime income annuities too, they will have some type of fee again because they're guaranteeing you an income. On the growth side, though, there's accounts out there with fees and without fees. Of course, if there's a fee, there's some type of value they're providing in the sense of maybe you have more access to more money yearly or something like that. But yeah, there's different ones out there, but there are companies out there that has uncapped growth potential. So you can get, if the market does 20% growth, 30% growth, you can get all of that in that, you can capture all of that without the downfall, anything else you want to add to any of that, Kyle?
No, I think you did a good job describing it. I think at the end of the day, everything comes back to the annuities just giving you guarantees on your money that otherwise aren't available or not provided by the market, by your employers, right, by financial advisors. Annuities, whether it's for guaranteed income in retirement or guaranteed growth without, or a guaranteed floor of investing in the market without risk and getting market like returns. That's what they come down to at the end of the day. And a fixed index annuity, it isn't expected to outperform the market. If you're looking for what's going to grow the best, stay in the market, but think of it as a just a way to diversify and to help you protect your retirement and to give you more guarantees on your retirement money. And with that, insurance companies, we turn to insurance companies to insure our houses. We turn to insurance companies to insure our cars and insure our life with life insurance. Fixed index annuities are offered by insurance companies to insure our money, to ensure that we're never going backwards and we're not losing it. Insurance companies are the best protectors that we use in our life in all these other areas, and you can use them as well to protect your retirement monies, especially as you're getting closer to retirement. Now, Renji, let's talk about these fixed index annuities and talk about the fees on them. There's some fixed index annuities that have fees, other ones that don't. Can you talk about, what the fees would look like and how that works?
Yeah, so like I mentioned before, some of these have fees, some don't have fees. The difference really is, let's say the fee is 1%, just to keep math simple. The way there are companies that will charge you that fee monthly, but most of the ones that we like to work with, it's annually. So you just, they're taking it at the end of the year, so it's not charged up front. But the benefit of having the fees, though, they'll give you a bigger bonus. So let's say if they're charging you a fee, their bonus might be 20%. I'm just throwing simple math out there. Let's say you have 100,000 and you're setting it up with a growth one with the fee. And let's say the 1%, it's a 1% fee. So they're charging you $1,000 at the end of the year for that 100,000 capital you have in there. But with the fee, they might be offering you 20% bonus. So if you think about it, they're giving you 20 years worth of fees up front. If you essentially think about it, right? Now, without the fee, you might not have a bonus. Sometimes you will have a bonus, but it's a lot less. And but the growth, like I said, if some companies have uncapped growth potential on either side. And most companies traditionally in an annuity, you can't touch the money for 10 years or whatever year period that you have the contract for. But there are companies out there, like I said before, with the fee, they give you more access to the money. Without the fee, they might give you access, they might not, but if they do give you access, it's a lot less than the ones that give you access. So that's the biggest difference. There's a lot more little minute things, but generally, that's the biggest things that are out there.
For sure. And how I like to look at them and in how I like to recommend annuities for my clients that I'm helping is a solution that has no risk and no fees. Yes, there can be a fee. When you elect to have a fee, it usually comes with additional benefits. But for my clients and the conversations we're having, if it comes down to they're looking for a safe solution for a portion of their money, let's go with something that has absolutely no risk and absolutely no fees, right? That way, your true worst case scenario is if you put $100,000 in this account, even if we enter another Great Depression, and 10 years from now, you're still going to have your $100,000, right? And for people that are getting closer to retirement age, when their financial advisors start to tell them to diversify and to keep some of their money in stocks, some of their money in bonds, it's typically recommended that they have a 60/40 stock bond allocation, is what it's called, where their financial advisor will recommend that they have 60% of the money in stocks and 40% in bonds. And Renji, I don't know if I think we've had this conversation before, but the fixed index annuities can be a much better, a much greater alternative solution than sticking your money in bonds. And let's talk about that, bonds versus fixed index annuities. Um, I can try to find a graph here if you want to talk about it, but talk about the difference between bonds and between fixed index annuities, and then I'll add on a couple of points if need be, if you don't cover everything. But like, what's the difference between bonds and annuities as far as people having their retirement money invested into these two different options?
Yeah, so bonds back in the day when sorry, excuse me.
You're
Back in the
good.
day with our grandparents and stuff, bonds made a lot of sense. You had a guaranteed growth. It wasn't, or it's not a guaranteed growth. You got a certain percentage of growth every year and stuff. It did good, and it was You didn't get a lot of losses either, if any. Problem now is interest rates interest rates are higher, bonds don't do as well, right? So with interest rates for everything being as high as it is right now, bonds haven't been doing that well. So when you look at a fixed index annuity, you're mirroring what the market does. So essentially, the reason we like fixed index annuities over bonds is just the potential for growth is so much better. Because in both cases, your money's not going down that much, if any. With fixed index annuity, though, if the market does 20%, especially if you're in a growth account without a cap, you're getting all that 20%. Even if you have a cap and it's at 10%, you're getting 10% growth. On bonds, right now, especially, it's not growing anything at all. So that's why we like to recommend a fixed index annuity over a bond. And this is something too, we've talked about this on a previous episode. If you think about pension plans that our parents, grandparents, or whatever had back in the day, they were they were kind of like bonds, right? You had when the pension plans, when you turned on the income, it was guaranteed lifetime income. And back in the day, pension plans all had health benefits too. You don't see them that much anymore. But if you look at these fixed index annuities, especially the guaranteed lifetime income ones, they actually work similar to the pension plans. Actually, I think they work better than the pension plans because the pension plans back in the day, they just had a fixed percentage growth every year, right? With the indexed
Hmm.
annuities, though, you can have the growth that the market does, so the growth potential is way better, and your money is protected in a pension plan or in the fixed index annuity, and you can get the guaranteed income in both cases too. So the way I see it, if you're taking out 4% of every year out of your pension plan or your fixed index annuity, you're gonna that 4% is gonna be way higher in an indexed annuity than it would be in the pension plan if it's only giving you a guaranteed percentage every year, right? So, and one of the ways I like to make the people think about how fixed index annuities can benefit them a lot too. Same example I used before. Let's say you have $100,000. If the market goes down 40% like it did back in 2008, now let's keep math simple. Let's say 50%. Uh, if the market goes up 50%, you have 50,000. Now, when the market goes up 50%, a lot of people think they're going to be right back up to 100, but you're going to be at 75,000 because it's 50% of what you have, which is the 50,000. Now, imagine
Hmm.
if you had a fixed index annuity or an IRA with the floor. When the market goes down 50%, you're still at 100,000. Now, when the market goes up 50%, you're at 150,000. If you have an uncapped index, even if a capped index, let's say it caps you at 10%, you're at a 110 instead of what you would have been in the market. Now, that's just 1 year. So imagine what that account will look like if you compounded that over 10 years or however long you have before retirement, how much more money you would end up with, right? So this is why a protected account is going to do way better than an unprotected account at the end of the day, with or without fees. Anything you want to add
Correct.
to that, Kyle?
Yeah, the only thing I wanted to add was just the fact that, bonds, while they are seen as a safer investment, they still don't have any guarantees of protection from the market, and bonds can actually lose you money too. Whereas the fixed index annuities do have a true protection and a guaranteed floor. That's one more thing to think of. And still, bonds are usually managed by a financial advisor, so they'll still have fees attached to it as well. So not only talking, bonds traditionally will have lower rates of return than what you can get inside of a fixed index annuity, but they also can still go backwards and lose money, and you can still have um, fees that are attached to it. Whereas fixed index annuities allow you to remove those two risks, the market risk and remove the risk of fees eating at your growth of your money, right? With that, Renji, um, is there anything else that we should talk about on today's show? Because I think we've done a pretty good job covering how and why they work, when to look at it, when to maybe start to think about adding a fixed index annuity to your portfolio. Is there anything else that you can think of that we should go over today, as today's show is meant to go deep into fixed index annuities and allow people to start to understand how and why they work? Can you think of anything else?
Yeah, one more thing, I think, and this is an important thing, probate. You can avoid probate with fixed index annuities.
True.
A lot. I still talk to one of my clients that has been in probate court for 3 years because
Hmm,
of their dad's 401k and stuff like that. They're fighting that still. But with fixed index annuities, you don't have to worry about going to court for probate. It goes to whoever you name as your beneficiary without any issues. And you just have to pay taxes and stuff like that on if it's a tax deferred and all that stuff. But yeah, probate's a huge uh, protection from, uh, or it's a huge protection for you from the government.
for sure. Do you want to talk about the downsides to the fixed index annuities? I mean, I feel like we've talked about the
Yeah.
pros and all the benefits, but let's talk about the downsides too. And
Mhm.
one of them, now I don't view it as a downside personally, but one of the top concerns about the fixed index annuities is that you lose liquidity to your money, which I call it the liquidity myth. Because in retirement, anyways, you are not going to want to pull out all of your money for two reasons. Number one, the money that you pull out and you take out as income is all going to be taxed, right? So if you pull out, let's say you had a $1 million portfolio and you pull out all $1 million out of the stock market, you're going to have a $1 million tax bill. Same thing with your fixed index annuity. If you put all your money into it and you pull it all out, you're going to have a large tax bill. That's the first problem. The second one is also that in retirement planning, part of your conversation about retirement planning should be, how do I make sure my assets last me my entire life and I don't run out of money? Running out of running out of money in retirement is called needing a retirement do-over, which means you have to go back to work. And I don't think that that's in the plans for anybody when they go to retire, right? So part of the conversation needs to be, how do I take my $1 million of assets and make sure I never run out of money for the rest of my life? And all financial advisors follow what's called the 4% rule, or the safe withdrawal rate, which means that you can safely withdraw 4% from your accumulated assets and in any given year, and you should statistically not ever run out of money in retirement. So financial advisors have you follow the 4% rule to make sure that your assets can last you your entire lifetime, right? With all fixed index annuities, even from the start, in year one through typically year 10, there's usually 10-year surrender charge annuities, which is one of the downsides. We'll talk about that here in a second. I'm getting there. You have what's called free withdrawals, which means in any given year, you can either withdraw maybe 5, 7, or 10% of your accumulated value without any penalties or any charges. If you want to go over that amount inside of a fixed index annuity, there may be a charge or there may be a fee, right? Which, number one, would be why we would not recommend you put all of your assets into a fixed index annuity anyways, right? Only do a portion. That way, the other portion of your money is totally liquid, right? But financial planning has us only taking out 4% a year for income. So you should do the same thing inside of your fixed index annuity. And if you stay under whatever the free withdrawals that are allowed that they give you inside of your fixed index annuity, you will never incur any charges or any fees. But that is one of the downsides that people think of when they hear fixed index annuity. They think that their money is truly tied up for 8, 10, or 12 years. Because most annuities do have a surrender charge, is what it's called, or a surrender period, where if you were to cancel the annuity contract, the annuity company is going to keep some of your accumulated value. Now, number one, when you set up a fixed index annuity, it should be a long-term strategy to protect your assets from market risk, but to give you, some market-like returns, right? So when you set this up, it shouldn't be in your mindset that you're going to cancel this out within 10 years. And we'll just use a 10-year period because that's the typical length of an annuity for their surrender charge, right? After 10 years, you're completely free. You can take out all your money if you wanted to, but remember, you're going to incur taxes on all that, and you're going to run the risk of running out of money in retirement. But within those first 1 to 10 years, there may be a slight charge if you go over whatever they allow you for free withdrawals. Free withdrawals are meant to allow you to access some of your money inside the annuity if you want to for income. And these annuity companies know how retirement planning works. So they're typically allowing you over 4% withdrawals should you need it for income. So you can set up an annuity. Yes, it might have a 10-year surrender charge on it. And why is that? It's a trade-off, right? Just like anything, there's pros and cons. For you to have guaranteed protection from the market, the annuity company just wants to make sure that you keep your money with them for at least 10 years. You get contractual protection for your contractual commitment to store your assets with them for 10 plus years, right? When the insurance company knows that they're going to have all these policyholders that are going to keep these annuities for 10 plus years, that's how they can manage their investments to give you market returns without the market losses. If they have, tens of thousands or probably hundreds of thousands of policyholders, everybody who's going to keep their money in there for the long term, they can make smart and managed investments on their end with everybody's assets in this large pool of money. And that is how they can protect everyone's money from the market, but give you market like returns. So there may be a surrender charge if you want to cancel out and pull all of your money out. Sure, they might not give you all of the growth, but you still have the guaranteed protection from when you put your money into that account in the first place. You will lock in all gains you had prior. They may just keep a portion of it if you cancel and pull out all of your money. But anytime you're going into a fixed index annuity, it should be for a long-term goal. And essentially, you should probably never cancel that fixed index annuity. It should be something that you have set up for the rest of your life. And with that, yes, this can be seen as a downside. There are surrender charges. You do have limited liquidity where you only have a certain amount of free withdrawals. But like we said, especially because this is a retirement account, you do need to know the total rules of retirement, which is you have to follow the 4% rule, which is 4% of your assets any given year. That's how you can avoid running out of income for the rest of your life. So that is one of the downsides. Um, Not having total and complete liquidity to all of your money, but you shouldn't want to in the first place. Um, Renji, I went over that downside or that con. I was trying to think of any other as I was talking, but that's usually like the number one hiccup and the number one holdup with a fixed index annuity. Would you agree? Is there anything else that you've ever heard of before that
No.
kind of holds people up when they hear annuities?
Yeah, the biggest things I hear is the liquidity and the contractual period where they can't touch, all that, and then the fees and stuff. So this is what I like to, the example I like to use. Let's say you did have that money in the market, right? And you have, or let's say you have it with the financial advisor, and you have their fees with them. Now, the biggest difference here is, yes, you might have all liquidity, like Kyle said. You might not want to access all that money though, because then what do you have saved for retirement, right? But even if it's not the case, you have fees with your financial advisor, and your money's not protected. So when the market goes down, you're losing even more money. Here, like we said before, there's accounts with fees and accounts without fees. Now, let's say you didn't choose an account with the fee, and so you have no fees or anything. Now, if the only fee you have is if you overdraw over the free withdrawal amount, now each of the even that the penalties go down annually too. So it might be higher up front because again you just got the contract, but within each year that amount might go down. So by the time you get to year 9, if it's a 10-year contract, your year 9 might be 1% fee on anything you overdraw, right? And after 10 years, if it's a 10-year contract, you don't have any more penalties, but you still have the market protection. So if you're younger, let's say, and you have more than 10 years to retirement, and you have old 401ks or IRAs or something, these are perfect for you because you're not going to touch that money anyways. So it doesn't matter if it's a 10-year contract. And with these companies, like we said, you have free withdrawal amounts you can take out without penalties. But that's for emergencies, right? But you should already have emergency funds that so that you don't have to touch these. But let's say in this case, now your 10-year period is done and you're close to retirement. Now you're fully liquid and you have the market protection. Like, So the way I see it,
Yeah,
even if you overdraw and you have that penalty that you have to pay the fees for, you're still protected from the market. So unlike in a traditional financial advisor's money, you're paying the financial advisor and your money's going down in the market. So when you add up that amount, I think I've done this with a few clients in the past that was adamant about looking at what the numbers looks like. It actually you're paying more with the financial advisor because not only the financial advisor fees, also the money you lose. That's something you don't calculate take into calculation, so but in my eyes, that's a fee because you're losing
yeah,
money in the market that you don't get back unless the market goes up 100% without going down again. Then you can get it back up to that. But the way we know the market's been, that's not always factual, right? So
yeah,
in the annuity, though, even if the market goes down, your money's protected. So if you ended up taking out more than the withdrawal time, um, then you're paying a small penalty for that protection, is the way I see it. But yeah, I
for
don't think
sure.
there's any other problems that I've come across.
The only other thing I would add is that, people may have prior assumptions about annuities that come from maybe their parents or grandparents. And what I'll say is that if you haven't looked at an annuity over the last 10 years, these aren't your grandparents' annuities. They have come a long way. Um, they've come a long way. In regards to that, I think the last thing we haven't talked about, we've mentioned before on previous shows, there's the five pillars of money: safety, liquidity, rate of return, taxation, and fees. We've talked about the safety, where fixed index annuities are one of the only vehicles for putting your retirement assets where there's guaranteed safety, meaning that you're not going to lose any money if the market crashes, right? Liquidity, we just talked about the liquidity. You do have free withdrawals that you can access. Um, Rate of return, we didn't talk about. I tend to tell my clients that rate of return inside of the fixed index annuities to expect somewhere around the range of 6 to 8% rates of returns. Obviously, it is going to be based on the index or the underlying index account that's attached. I tend to say that they'll average about 6 to 8%. Renji, is that usually what you say as well? Is somewhere in that range?
Yeah,
Perfect. So that's the rate of return. We did talk about the fees, where there can be zero fee fixed index annuities. Some of them can have fees as well. But then the last thing we didn't touch on, we didn't talk about, is the taxation. And simply enough, the taxation of these fixed index annuities are going to be exactly how the money was already taxed before. What I mean by that, if this money is coming from a Roth IRA and you roll it over into a fixed index annuity, some companies, double check with the advisor that's helping you, some companies can allow you to keep it a Roth, meaning all gains in the future stay tax free. And then when you take out your income, it's also still tax free. And then if your money's coming from like a 401k or a traditional IRA, something that was, tax deferred previously, your fixed index annuity is going to stay tax deferred, meaning your money is going to continue to grow without taxes interrupting any of the growth. And then when you retire and you start to take out the income in retirement, then you're going to be taxed on your money, just like you would have been in your 401k. And then the last point on that is for doing any kind of rollover from a 401k to a fixed index annuity does not incur any penalties. There is no taxes. I'm sure people have heard of the term a 401k rollover before, or an IRA rollover. Anytime you make a 401k rollover to another account or a transfer like that, there is no fees, there is no taxes. So anytime we're making these recommendations to our clients, there's no taxes incurred to them. There's no fees that are incurred to them. They don't even pay us as advisors, right? And you're probably thinking, how does that work? How do you guys get paid? Of course, we do this as our profession. This is our career path. We're compensated by these different annuity companies, though, for bringing them a new policyholder. So for bringing them a new policyholder, a new contract owner, they compensate us as a referral fee or a commission, right, for bringing them new business. And that's how we're compensated. So all of your money truly goes from whatever account it's in now to a fixed index annuity without you having to pay us, without you having to pay the government or to pay Uncle Sam or to even pay the insurance company. You may not have to ever pay them a fee because there's options that don't have any fees. So when we're talking about making these fixed index annuity recommendations, they truly can come with absolutely no risk to you. The only other thing you may be thinking of is, what if these companies go under? And there's a reason, ourselves plus our companies that we contract through, we vet out these companies. They are all rated A and higher by A&M Best and Moody's and these other different companies that provide what are the financial ratings of the strength of the companies, really. We'll only ever
Stability.
use an A or higher rated company. And the reason for that is an A rated company has never gone under inside of the United States of America in the history. So we'll only ever recommend our clients put their money with A-rated companies for the protection and the guarantees that most people are seeking with their retirement money. And with that, Renji, this has been our longest show now, but I think it's good
Yeah.
because we went in depth. We went into the weeds, talked about all the pros, all the cons. We talked about the 5 pillars within annuities and fixed index annuities. Are we missing anything else, or is there anything else that you want to
Yeah.
end us with?
I want to add just for people that are watching, just for their mind to be at ease. The way that we're able to roll this money into other accounts is because just like any big companies, when you go from one job to another, they do a 1035 exchange, which is the same thing we do, which keeps you from having to pay taxes up front. You keeps it tax deferred to, like Kyle said, when you access the money. And then the other thing, this is one of the biggest concerns I get asked is, wait, does your commission come out of my account? Nope. So these companies that we work with, they have their own marketing budget. And a lot of these companies are been around for 100 years or more and A-rated, but they don't do their own marketing. It's all by word of mouth. So people like us or other people that talk to them, so they have their own marketing budget that we get paid from. So whatever referral fee that we get, it's not coming out of your capital. Your capital is protected and it doesn't get used for anything else. Your money's protected. So just to keep, I think that was two things that came up that I was thinking about when you were talking. But yeah, other than that, I think, like you said, this is, I think, one of our biggest episodes. But it's important
Yeah,
to talk about because there's so many people retiring every day, so many people losing a lot of money in the market. And to be honest with you guys, my parents, both my parents, have fixed index annuities, and thankfully they had we set them up back in 2001 before the crashes that happened in 2000 or 2021 instead of 2001 before the crashes that happened in 22, and they didn't lose any money. And it was kind of funny because they're not that tech savvy, so I set up everything on their desktop where they just have to double click and put their password in and it shows up their account. But so we set them up back in November and December of 2021. They called me in March or April of 2022 and they said, "Hey, all our friends are losing a lot of money in the market. How's our accounts doing?" And I hadn't checked it because again, they're protected, so I didn't feel the need to check it. But when I checked it, they hadn't neither of them had lost any money, and both of them, one of them had 3,000 growth, one had 4,000 growth, which which is just powerful right there that your parents didn't lose money when all of their friends and family were losing money, right? So that's the biggest thing for me. So Kyle and I, we do this to have that same effect. We treat everyone like family when we talk to them, and we want to protect your money in the same sense. So fixed index annuities are a great option to add on to what you might already be doing, just to have that market protection, especially if you're closer to retirement.
absolutely. And we talked about a lot of different ways on today's show that these can be customized to number one, maybe whatever you want, or number two, whatever way that we can help you achieve your retirement goals. They're very customizable. And unfortunately, you can't just call up one of these companies and set it up by yourself. You do have to go through somebody that's licensed, somebody that knows and understands how these fixed index annuities work, why they work, can easily and confidently describe them to you. And that's what Renji and I have been doing, over the last 2, 3 years, as Renji had mentioned, and what I've been doing over the last 6. So if you guys have any questions on fixed index annuities, we're here to help. These are one of our areas of specialties that we work in. We do talk about, as well as, like, as far as wealth building, we recommend you guys get into cash flowing and passive income assets. But also, if you've been working already 20, 30 years, you've got all this money saved up in your 401k and you're getting ready to retire. Maybe getting into assets isn't for you, but you're like, how do I just retire better and retire with more confidence? And that's what these fixed index annuities can help you do. So we're here to help. If you guys would like, you can follow us on our social media platforms. My TikTok account is at the Wealth Academy with a K. We'll have that linked below. My Instagram is at Kyle Demian, just my first and last name. Renji, where can people find you on Instagram and TikTok if they want to connect with you and ask you for help with fixed index annuities?
Yeah, at Regiments. It's like Benjamins with an R, but Kyle will put it on there too, so that way you guys can spell it correctly to find me, because it's not spelled uh, like a normal Benjamin. But yeah,
Absolutely. Well, connect with us there. We don't charge anything for consultations to see if we can help. And like we said, if we do find out together that a fixed index annuity is a good recommendation for you, to set it up, like, there's no upfront fees, there's no charges for you either. We can truly make these recommendations and look at these options for you with no cost to you out of pocket. If you wanted to transfer $100,000 over, you would see from day one your account has $100,000 in it. Nothing comes to me, nothing would come to Renji, and we get compensated by these different carriers that we represent. And so if that is something that is interesting to you guys, you want to look at it, see if it may be right, we're here to help. Feel free to connect with us on social media and let us know. That's what we do. And until next time, we'll see you guys on the next show. Be sure to like, comment, and subscribe. And drop your questions or maybe comments below, especially regarding to fixed index annuities, because we could do maybe a case analysis if you guys would see benefit in that, or kind of just break down maybe what one of these illustrations may look like and kind of just run over the projections and kind of go into a deeper dive if you guys wanted us to. But let us know below in the comment section. And until next time, we'll see you guys on the next podcast. Take care.